Welcome to our channel. Today we're diving into the secret to choosing the best stocks for your portfolio. Whether you're a seasoned investor or just starting out, these tips will help you make informed decisions and maximize your returns. Look, I get it. The stock market can seem like a scary place, especially with all the confusing jargon and constant ups and downs. But the truth is, investing is the single most powerful tool you have to build wealth over the long term. It's how ordinary people become millionaires, retire early, and achieve their financial dreams. In this video, I'm going to break down the exact strategies the Investment IQ Insights team uses to pick winning stocks in a way that's easy to understand and apply. So, if you're ready to take control of your financial future, sit back, buckle up, and let's get started. And don't forget to subscribe to our channel so you don't miss any future videos. Before buying any stock, know your goals. Are you investing for retirement or to buy a house soon? Your timeline affects your stock choices. Young investors can take more risks. Time allows recovery from market dips. Focus on growth stocks like tech startups. Near retirement, prioritize capital preservation. Look for dividend-paying stocks. Your risk tolerance is personal. Align investments with your goals and risk appetite. Look, I'm not going to sugarcoat it. Not all companies are created equal. You want to invest in businesses that are fundamentally sound, meaning they have strong financials and a competitive edge. So how do you spot a quality company? Start by looking at their financials. Dig into their revenue growth, earnings per share, and debt levels. Are they consistently profitable? Do they have a solid track record of growth? These are all green flags. Next, consider their competitive advantage. What sets them apart from the competition? Do they have a unique product or service, a strong brand, a loyal customer base? The harder it is for another company to come along and steal their market share, the better. Remember, you're not just buying a stock, you're buying a piece of a business, so make sure it's a business you believe in with a solid foundation and a bright future. Okay, so you found a company with solid financials and a killer business model. That's great, but even the best companies can be bad investments if you overpay for them. That's where valuation comes in. Valuation is about figuring out what a company is worth using key metrics. One common metric is the price-to-earnings ratio, or PE ratio. This tells you how much investors pay for each dollar of earnings. A high PE ratio could mean high expectations or overvaluation. Another metric is the price-to-book ratio, or PB ratio. This compares market value to book value, the value of assets minus liabilities. A low PB ratio could indicate undervaluation, but consider the industry. For a deeper dive, there's discounted cash flow, DCF, analysis. This method projects future cash flows and discounts them to present value. It's time-consuming, but can estimate intrinsic value accurately. The bottom line is, don't just buy a stock because it's going up. Understand its true value and if the price makes sense. All right, let's talk about growth. When you're investing in a company, you're essentially betting on its ability to grow its earnings and, as a result, its stock price. So, it's crucial to find companies with a long runway for growth ahead of them. One way to assess growth potential is to look at industry trends. Are they operating in a growing market? For example, the e-commerce industry is booming, so companies in that space have a lot of potential for expansion. On the other hand, industries like traditional retail are facing headwinds, so their growth prospects might be more limited. Another important factor is innovation. Is the company investing in research and development? Are they coming up with new products and services that will keep them ahead of the curve? Companies that are constantly innovating are more likely to stay relevant and grow over the long term. Remember, past performance is not a guarantee of future results. Just because a company has grown rapidly in the past doesn't mean it will continue to do so. Focus on companies with a clear vision for the future and a track record of adapting to changing market conditions. Okay, we're getting to the fun part, building your actual portfolio. But before you go all in on that one hot stock you've been eyeing, let's talk about diversification. Diversification is all about not putting all your eggs in one basket. In other words, don't invest all your money in just one or two stocks, no matter how promising they seem. Why? Because the market is unpredictable, and even the best companies can face unexpected challenges. Instead, spread your investments across different companies, industries, and even geographic regions. This way, if one sector or company takes a hit, your entire portfolio won't be decimated. Think of it like having a safety net for your investments. One way to diversify is to invest in index funds or exchange-traded funds, ETFs. These are baskets of stocks that track a specific market index, like the S&P 500 or the NASDAQ 100. They offer instant diversification and are a great option for both beginners and experienced investors. The key takeaway here is to create a portfolio that aligns with your risk tolerance and investment goals, but also provides enough diversification to weather any market storms. Congratulations! You've built your investment portfolio, but the work doesn't stop there. The stock market is constantly changing, so it's crucial to stay informed and make adjustments as needed. Set aside some time each month to review your portfolio's performance. How are your individual stocks doing? Are any sectors overperforming or underperforming? Have your investment goals changed? Based on your answers, you might need to rebalance your portfolio. Rebalancing means selling some of your winners and reinvesting the proceeds into other areas that have lagged or that you want to increase your exposure to. This helps you maintain your desired asset allocation and risk level over time. Remember, investing is a marathon, not a sprint. It's not about trying to time the market or make a quick buck. It's about staying disciplined, staying informed, and making adjustments along the way to stay on track toward your financial goals. Investing isn't just about numbers and spreadsheets, it's a mental game. Emotional discipline is key to long-term success. Avoid following the herd. By the time everyone is talking about it, it's often too late. Bear markets are natural. Don't sell at a loss. Stick to your plan and trust the market's rebound. In today's digital age, there are countless tools and resources available to help you make smarter investment decisions. Gone are the days of relying solely on gut feeling or newspaper stock quotes. One of the most powerful tools at your disposal is a stock screener. This allows you to filter stocks based on specific criteria, such as market cap, P/E ratio, dividend yield, and more. This can save you hours of research and help you quickly identify stocks that meet your investment criteria. Another game changer is the rise of AI-driven investment platforms. These platforms use sophisticated algorithms to analyze massive amounts of data and identify investment opportunities that humans might miss. While it's important to do your own research, these tools can be a valuable resource for generating investment ideas and managing your portfolio. Remember, technology is your friend when it comes to investing. Don't be afraid to explore different tools and platforms to find what works best for you. Thanks for watching. If you found these tips helpful, don't forget to like, subscribe, and hit the notification bell for more investment insights. Happy investing. Remember, investing is a journey, not a destination. It's about making smart decisions today to secure your financial future tomorrow. So, start by defining your goals, do your research, and don't be afraid to get started. The sooner you begin, the more time your investments have to grow and compound, setting you on the path to financial freedom.